Welcome to the Big Mike Fund podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome Neil Wahlgren. Hey, Neil.
Hey, Mike. How are you?
Thanks for coming on a podcast. Neil is, I guess, co-founder and managing partner at the MAG Industrial, company specializing in industrial strategy. So awesome to have you. But first, could you tell me a little bit about you and your family? It's the first step. We always do it on a podcast. Where do you live? Family, kids, cats, pets, whatever works.
Yeah, absolutely. Neil Wahlgren, managing partner at MAG Capital Partners. I'm based out of San Francisco here. I'm a Northern California native. I had a prior career as an Air Force officer and pilot. So I went to the Air Force Academy after growing up kind of in the East Bay area here in NorCal. Air Force Academy in Colorado Springs, 4 years there, undergrad, and then ended up earning a pilot slot with the Air Force. So I ended up going through additional couple of years of training, ended up flying the C-130 Hercules. So flew that, stationed in Japan 5 years, about 2.5 years total around the Middle East, and been to about 109 different countries. So really kind of a neat way to spend your 20s and early 30s there, kind of flying all over the world and, getting to understand logistics and movement and troop personnel and all sorts of, interesting military missions through that. So I did that for about 10 years. And finally decided, hey, let's think about having a family. It's a little hard when you're on the road all the time. So transitioned, out of the military there. Got my MBA at Texas A&M, courtesy of the military covered it. So that was nice. And then ended up moving down to Southern California a bit. Had a run for about 4 years at a biofuel startup, which was interesting. Was employee number 30, up to about 300 people, and then full cycle down to zero. But really, got to get my feet wet on the entrepreneurial side with that. In the process, started investing on my own and some single family, and then ultimately moved up to San Francisco, where I've been the last, about 11, 12 years. Up here, met my wife. I have 2 children, so 2 boys. One's turning 13, and one's 6 months. So we got full spread in the family here. We live in the Marina District in San Francisco. Worked for a couple of years on a small capital shop focused on kind of syndicating commercial real estate, individual single asset deals. And through that relationship, met my partners at MAG Capital back around 2015, 2016.
That's an awesome overview. So first of all, thank you for your service. It's so great to hear that you had a whole adventure through the U.S. Air Force and traveled the world. And it's awesome to hear you went through a startup in biofuel, and that didn't quite work out. So some lessons learned from there. And then how did you wind up really in industrial real estate? This is not a field easy to get into. It's one of these strategies that typically reserved for big players because the assets are in industrial size type of buildings it's a unique strategy. It's not easy to break into unless you work for some big shop that have been specializing in that. So
yeah, no, it's a great question. And I always tell people, industrial is interesting because most people can live their whole life without really ever setting foot in a manufacturing industrial space, right? Whereas retail, everyone's been in retail. Everyone's been in, an apartment or lived in one, at some capacity, almost everyone in office. So it tends to be, a little less familiar for folks from a, actual brick and mortar standpoint. But, really it's a fascinating asset. My 2 partners, Dax Mitchell and Andrew G are really core real estate players. So they've been commercial brokers, they've been investors, they've been developers. Andrew was an appraiser in the commercial side for 10 years. So they both have about 30 years experience each, deeply into, all just a whole journey of different commercial real estate. So the 2 of them kind of founded on really net lease originally. So they were doing net lease medical office. And then once, kind of had the foundation there, saw a lot of opportunity in the industrial space. So as they were getting into that, they were one of about 8 sponsors I worked with on the previous firm. And really, it was great to be able to introduce a network of individual investors to be able to work a syndication model and bring that capital as limited partners into the deal managed by Mag Capital. And so really, we vetted the team a lot. I got comfortable with the two partners there, and we did about 4 or 5 deals together. And at that point, really, I had the model down. I really liked the individuals behind the company there, and had an opportunity to join them full time. So that was really my transition point. Those were my 2 top criteria for finding what firm I wanted to jump to full time there.
Yeah, that's really, really cool. It's a nice venture, I guess, journey, and it sounds like you found your calling as specialty as it is. It's actually great. What do they say? Don't be a jack of all trades and master of none. Be a specialist,
Yep.
and this is a great
Yep.
specialty.
I've heard a niche is rich. So, you find a little, category that not everyone's doing, and do it well, and it'll work really well for you.
Yeah, riches and the niches. I heard that too.
I
So
like
that's
that one
that's a
too.
great niche. So what's happening today? We are recording this in early October 24. Fed cut rates as the first sort of sign for some support in the interest rate policy. You certainly in this higher interest rate environment, are you able to find more deals? Is it more of an environment conducive to better bargain hunting versus when the rates were low? And what are you seeing today? Are you finding great opportunities? And yeah, just talk about sort of a bigger picture. What's happening in the industrial? And you do typically what? Seller buyback leases is a specialty also trade where you buy from the owners and then lease back.
Yeah, exactly. So as an asset, we're effectively acquiring absolute net leased industrial real estate, usually 20-year full net leases where our tenants will pay 100% of the expenses on the property. That's taxes, insurance, everything from roof replacements down to landscape, you name it. So it becomes much more of a predictable cash flow play. And then how we acquire, really, that's a niche within a niche almost. And that's through, like you mentioned, sale-leaseback. So most of our deal flow is driven by M&A with a private equity backer coming in, typically buying a family-owned manufacturing business. Typically, that family-owned business owned its own real estate, and then that PE shop comes in, buys that firm, including the real estate, and then what they want to do is effectively monetize that real estate and move that capital over to the operating side of the business to help grow the company. So we are effectively the monetization partner on getting the capital out of that real estate and allowing them to effectively change roles from an owner to a tenant, and we change roles from a buyer to a landlord. And so really it's all a paper transaction inside the shop. Nothing changes, day in and day out. They continue making, whether it's aerospace parts or manufacturing or, aluminum extrusions, whatever it might be that shop does. So really, when you asked about our deal flow, almost 90% of it is driven by M&A activity. So as long as mergers and acquisitions are occurring in the space, we are tangentially the recipient of a lot of that deal flow that happens through those M&A activities.
That's really fascinating. I didn't realize this was the great specialty and the M&A. So M&A usually does really well. The volume is up when the interest rates are low. Now the volume is pretty low because the interest rates are high. Well, like beginning to come down, but we just started. So are you able to find interesting deals still happening? I assume it never goes down to zero. It can shrink from peak of the volume to wherever it is now, but it's never, a zero. There's still something happening.
Yeah, and it is a good point. So in low rate environments, there's a ton of mergers and acquisitions and sales, and it's just a flurry of activity. But you also get a flurry of liquidity in the market, a lot of buyers, a lot of big institutional shops competing, and that was kind of what we saw in 2001, right? Early 2022, and there was just so much money in the market. Deals now that are trading at 8 caps, 8.5. I mean, we might bid at 6.5 and it would trade for like 5.5 cap rate. So it was just so much money being thrown in that it was driving the values to, what we felt was no longer, grounded in reality there. So we ended up sitting out for about 8 or 9 months in that period, really not buying anything. And then once rates started coming up, we still saw activity. It shrank, but we suddenly, we're seeing cap rates go back to a more normalized level, and then now, really a quite attractive level from a historical vantage point. We're still pretty regularly able to find good mid-market real estate with private tenants. And that's nice because we kind of limit the pool that we compete with. We have to do our own credit analysis of these private sellers who become tenants. And not a lot of firms have that in-house capability. So we compete with a smaller pool. We're able to, still get a nice yield. And then ultimately, we lock in the cap rate, we lock in long-term fixed rate debt. And really the spread between that is what generates the cash flow yield to our LPs.
So let's dive into that a little bit. So what kind of cap rates are you finding these deals at? What kind of fixed rate debt are you able to lock in? What's the equity spread? I think that's the term between the cap rate and the mortgage rate. And it's one of the few strategies that actually has a decent positive spread.
Yeah,
Multifamily
absolutely.
storage doesn't have much of a spread. Sometimes
Yeah.
it's negative.
And that spread will always move. And we target, whatever the fixed rate interest is at the time. We look to usually get a cap rate, about 150 to 200 basis points higher. So we saw, just to use an example, our second industrial fund, we're just closing out. We have one final acquisition to fully stabilize it. That one, I believe, over the last 12 or 14 months, we've acquired about 22 industrial assets. We've averaged, I think, about an 8.3 acquisition cap rate. And then I believe the debt is about 6.5% average across that spread there. So, able to maintain, that basis point spread we talked about. That usually will generate, somewhere between about a 6 to 9% initial yield on each asset. And then when you diversify it across a fund, you get a nice upfront cash flow. On those leases, you're going to have annual rent escalators built in. So every year the rent goes up, increases that cash flow, and then you're also shielded from increasing expenses. So all that goes to your tenants. So it's a very much more predictable cash flow play. And we're able to appreciate the asset during, roughly a 5 to 6 year hold before we sell the portfolio.
So that's a great explanation. So the math works out as cash flow improves, I guess NOI improves, valuation improves. So you're collecting pretty decent cash and you have sort of not a guaranteed, but likely improvement in the valuation of the asset. Do you ever take it to refi at some point as rates fall? I assume that might become viable again because the interest rates in the past were falling for a long time, and they spiked. And now, as they fall again, maybe some interesting opportunities to refi as part of the strategy.
Yeah, so that's what's nice with the fixed rate debt, right? So we don't have to do anything. The underwriting is pretty stable, where rates could go up, rates could go down. We could sit back and say, hey, we have this yield that we underwrote for. However, if rates do go down to a point where it makes sense to refi, we can lower that interest debt service, and now we've increased the cash spread, and that would definitely be a positive effect on both cash flow and overall IRRs on the fund there.
I got you. And what's the typical asset size that you try to acquire? You said single tenant, some kind of industrial manufacturing. And are you seeing, so again, size of the opportunities typically, and then the next question, are you seeing any interesting, shift driven by the geopolitical friction with China, US-based manufacturing? Are you seeing anything interesting happening on that front?
Yeah. So size-wise, as an asset, I would say about 200 to 400,000 square feet is kind of our sweet spot.
It's pretty sizable. 200. It's like a big warehouse.
Oh,
It's a gigantic
absolutely.
warehouse.
Yeah. No, they're big operations. Sometimes several buildings on one parcel of land. Often they're a bit of a patchwork looking setup because you'll have a company that grows over many decades and adds additional structures, and you're buying kind of the accumulation of all that. But typically, we're buying $50 to $100 a foot. Replacement value right now is about 150 to 175. So, well below replacement value, kind of in the space we play in. And then, what you talked about with China, it's really interesting. I would lump in, kind of increasing costs of overseas labor. You have geopolitical uncertainty with China and, claims on Taiwan and the Philippines and the waterways there. You have, I mean, just yesterday you had the port workers, 45,000 of them went on strike. All of these add major uncertainty to what I call the global supply chain, right? And as that uncertainty stacks up, it adds, increased time and increased cost for manufacturers. We started seeing this back in 2018, 2019, heavily accelerated when COVID hit, for reasons we're all familiar with. And really during that last, roughly 5-year period, we've seen a lot of American manufacturers that previously produce their goods overseas. We've seen a lot of them move their manufacturing operations back to the U.S. So the term for that is reshoring. That reshoring really has been a very strong demand driver across a finite supply of industrial real estate across the U.S. for the last 3 to 4 years, and we foresee that continuing trend to keep going for probably at least the next 3 to 5 years.
Yeah, that's a great explanation. Reshoring. I heard offshoring, nearshoring, reshoring. Yeah, these
Yeah.
are great
Yeah,
terms.
and nearshoring is bringing to Canada or Mexico. So typically considered, less volatile overseas production spots. But, really any of those, basically bringing back to North America is going to benefit, industrial across those sectors.
Yeah, exactly. That was exactly my experience when I was in the technology world. We had an office in Nova Scotia, Halifax, and
Mhm.
Yarmouth. That was the nearshoring concept of
Yeah,
outsourcing to somewhere in India. I think at least in technology was a very popular trade. So,
yeah,
but
absolutely.
let's go back to the acquisition cost. So if I heard you correctly, you're buying at about a third of the price per square foot, about a third versus building new, which is phenomenal. And how old are these buildings? In essence, how much useful life, and with a triple net lease, all the upkeep, including the roofs, as you said, is a function of the tenant. But the only risk is on maturity of the lease. Can they go somewhere else? And you have to go
Mhm.
find another tenant. And it's a multi-year play, I assume. Nonetheless, it's something to think about. I guess your cost basis is so low that it's probably it doesn't matter. You're gonna find another tenant if this one wanted to move.
Yeah, so it's becomes much more of a contract play versus a true, core real estate play. So, as we're buying most of the new industrial being built, a lot of it is Class A. So think like your big Amazon, your Prologis centers right on the highway, super, sleek and nice. Those are going to be substantially more, right? We play in what we call kind of second generation. So often, properties are built 20, 30 years ago. Some are even a compilation of like 40 or 50-year properties that have been renovated over time. But again, like there's not a lot of there's not a lot of substance to the real estate. And it really is, we call them industrial boxes, right? It's 4 walls, a roof, some pavement outside. Typically, I mean, really it's a covered working space for warehousing, for manufacturing operations, for shipping and receiving, right? Usually maybe 5 to 10% of the square footage is office or bathrooms, but I mean, really most of it is just concrete flooring, very versatile space. And also being a little older, it doesn't really matter in our model because the tenant's going to maintain it, right? The bathroom breaks, they cover it. The roof needs replacement, they come in. And really the only time we come in heavily on the real estate side, outside of, building inspections every 1 or 2 years, we have a kind of a full service development arm within our firm. So, we stay in close contact with facility managers, and as that PE firm, if they're successful in growing the company, often they're like, hey, we need more space. They're contractually tied to that building, but we can say, hey, if they're sitting on excess land, which is quite often, we go, hey, we can build out another 40 or 50,000 square feet for you. And that's kind of neat. Ultimately, you might do the build out, say all baked in at a 10 cap, and maybe the original acquisition was an 8 cap, and now blended, you effectively have a 9 cap acquisition without taking on any substantial additional risk. So that's a nice way we're able to add some alpha and really increase our return profile compared to some of our
You
competitors.
can build to cost to 10 cap. That's remarkable. I mean, that's
Yeah.
great.
Yeah.
And the more I think about it, the more I'm impressed because really you're mostly in financial engineering. You're not really heavily doing real estate work where you have to deal with
Mhm.
improvements and dealing with all kinds of elements related to real estate. You're still in real estate, but you're really on a financial side. And yes,
Exactly.
like you said, further development if it's necessary on a given property. I
Yeah.
mean, that's honestly I love your model, and that's why we've started investing with you, and we're looking forward to do more because the model continues to make a lot of sense. Are you expecting to see more competition entering your field, or because of your existing relationships, you get into this, I guess, not heavily bid or overbid environments? When you get one of these private equity firms that buys one of these shops, do they put up the asset for bid? And are you competing heavily, or it's a little bit more of a friendly environment? Just curious.
Yeah, I mean, we have seen some new players come in pretty strong. For example, there's a Morgan Stanley net lease shop now. There's a JP Morgan net lease shop. They've seen, that, hey, this is definitely a, kind of under highlighted segment of the commercial real estate investment space. But I think we still do pretty well. We're nimble. We're a smaller shop. We can be a little more creative, right? For example, let's say our tenant on a lease back says, hey, we want to start at a lower rent than what we preferred. We're going to go, hey, on a 5-year horizon, we still want to be here. We might win the deal by going, hey, we're going to, instead of 2% rent bumps, we'll bump it up to 3.5% rent bumps for the first 5 years. That still gets us to our sales NOI target. And then maybe it levels out to more, stable 2% annual afterwards, right? So we can be a little more creative on how we structure things. If we love the tenant, if we love the basis on the deal, that's our two biggest criteria that we look for. And then, the rest is, just being creative and nimble as an acquisition shop to outcompete some larger competitors there.
So it's financial engineering, room to wiggle a little bit of what do you do with the rent escalations and some other variables that you can control.
Completely, yeah. And then the other interesting variable is really how do you control risk, right? And so, on paper,
What is the biggest risk? That's the first question. What is the biggest risk?
yeah, it typically is going to be a risk of default, right? So, or put it in layman's terms, what is the odds of my tenant staying in business and paying rent? And if they default on that lease, typically through either Chapter 11 or Chapter 7 bankruptcy, what is the odds that my lease will be upheld or rejected if they go through restructuring? And then if it is rejected or if I end up with an empty building, then I have to run some analysis to go, how long would it take me to release here? So that's why the fund structure is nice. You can really absorb those. They are very rare events. In 10 years, about 140 tenants, we've only had one default. So it's a really strong track record on that side. But controlling that risk, you have the guarantor on the lease. You can pursue a secondary guarantee, say from a parent company. You can, let's say they're, maybe having a turnaround story. You might say, hey, we're going to withhold a full year's worth of rent in escrow, and then once your financials improve to a level that we're happy with, then we'll release that back to the tenant there. And so there's different ways we can play with that where we still have a strong risk adjusted conservative basis and approach there, but we're still able to work with the tenants and put together strong deals.
Yeah, I appreciate that. So it's really credit underwriting. It's just heavy credit
Absolutely.
underwriting. The company itself, the parent, whoever's guaranteeing and making sure that you have high confidence it's going to get paid. And obviously, track record speaks for itself. So you've got really great story there. So, any sort of quick books or other just I ask usually for a book or advice. So any good advice for either passive investors or just folks who are most of the audience on this podcast are passive investors. They're not active operators. So I'm not asking you how do you get into the industrial. This is not an type of an
Sure,
easy.
sure.
But how do folks start investing in industrial? Does it make sense to just write your check in one of your funds? But it's a long cycle. Most of your stuff takes, what you said, 7, 8 years, right?
We usually talk about 5 to 6 years, but to your point, we're putting a 20-year lease on. Usually the most of the debt is 7 to 10 year fixed rate debt. So it's a model around optionality and predictable yield, right? And that is the core of our thesis there. Can we sell early? Absolutely, right? When 2021 came around, we sold a bunch of stuff early. We're like, this feels like a terrible time to buy and a great time to sell. And we did. We sold off a bunch of stuff that was some of it 3 or 4 years before we were planning to, just because cap rates were so compressed. Conversely, if we hit the 5 year point and we're going through a cycle like we saw last year, we might say, hey, you know what? There's no compelling reason to sell. We still have a strong tenant. We still have good cash flow increasing every year. We're going to, add another year or two and wait for, what feels like a more optimal time to exit. That's, a lot of timing optionality that we build around. There's no.
But you control the decisions. Effectively, investors are generally passive. Do you do one-off syndications or do you do mostly funds? So folks just.
Yeah, most of our industrial will go into the funds, but we do some net lease, sale-leaseback, and other asset types. So, the occasional standalone retail property, or, we just bought an office headquarters in a high-end suburb outside of Minneapolis recently, and, strong credit, good bones, good basis. So same effective strategy, just a non-industrial asset type. So we'll do those individual, but most industrial goes into our diversified funds there.
Makes sense. Any good book recommendation? Anything comes to mind?
Yeah. So I've become a bit obsessed about sleep lately. And so Matthew Walker has a book I read and actually have reread called Why We Sleep. And then I got one of those wrist trackers. I use Fitbit. And so the wrist trackers will actually like give you an objective sleep score, and you can kind of look at all the highs and lows in this book. Really kind of walks you through the different segments of sleep, how certain pieces of those, light REM and heavy REM and non-REM sections kind of affect your mood, your mentality, and they show it how it affects animals. Is really fascinating. And I've gotten a lot of that book in terms of optimizing what happens on those, 7 or 8 hours a day on the mattress, and how that improves your performance when you're, up and about the next day.
Yeah, that's an awesome recommendation. I think sleep is very important. Most of us underestimate, and we're tired, of course. So if you're not rested, it's harder to do what you do every day.
Yeah.
Thank you for coming on our podcast.
I was going to say with this new 6-month-old, I'm feeling it more than ever now. So.
Well, that's when you have small kids, your rhythms changes quite a bit. You get a little older, they sleep a little longer. You get a little more break from that. So, well, good luck with the 6 months old. Hopefully, it gets easier from here. What's the best way for folks to reach out if they wanted to learn more, a little bit of about what you do, Meg Industrial, your funds, etc.?
Yeah, absolutely. Love to chat more. Easiest way is either visit us on our website. It's www.magcp for magcapitalpartners.com, or just email me. It's Neil, Neil @magcp.com, and happy to chat further.
Thank you, Neil. Thank you for your wisdom, and thank you for sharing.
Awesome. Thanks, Mike. Appreciate you having me on.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.